Thanks for joining us here on Market Call. Welcome to the show. Lorne Steinberg is on the show today, president at Lorne Steinberg Wealth Management, taking your questions on global value stocks and fixed income. Here's how to get hold of us. 1-855-326-6266 if you want to give us a call. You can also send an email at marketcall@bnnbloomberg.ca. Lorne, great to have you today. Thanks for coming in.
Great to be with you, Marilla.
So we got some trade numbers out this morning, and if we're trying to dodge Donald Trump's ire, we're not doing very well because we have a surplus, much more than expected, or what the expectation was for January anyway. In this kind of trade war environment, I'm wondering, with all the volatility, what you say to investors.
I think it's really important to tell investors that this is a long game. You don't buy stocks, nor would you buy a house with the idea that if I don't like it, I'll sell it in 12 months' time. We need to buy companies that are going to be around for a long time, that will deliver growth and increase profitability for a long time. And when you think about that, in the next 12 years, there will be 3 presidential elections, and 5 years from now, we'll be talking about a bunch of other things that might concern us. And the companies that we're investing in have stood the test of time. Listen, most of us have lived through things like 9/11, the financial crisis and the like, and here we are today. And when I think back to the financial crisis, it feels like it was 50 years ago, but it was 15 years ago, and somehow we managed to get through it and come out even better afterwards.
Okay, so if you're an investor and you're looking for the fundamentals of a company that will stand through that time, let's walk them through what they're looking for.
So first of all, track record counts, and you want to look back to how have companies performed during down times when we've had recessions and the like. Companies that have been able to stay profitable through those times, continue paying their dividends as an example, have been able to survive. Also, if you look at some of the world's great businesses, those large companies also have the capacity, they can hire the best in the business. So Starbucks being an example, when their CEO wasn't working out, Starbucks can go ahead and hire the best CEO in the industry, and they spent $100 million for the fellow that ran Chipotle in the past. And so these large companies have the capacity, the wherewithal to be agile and make their way through. Look at when COVID happened, how quickly companies like Starbucks and McDonald's morphed their businesses almost immediately, moved to more takeout, and didn't skip a beat.
Okay, so let's talk a little bit more about that, because you also mentioned there's not a lot of room left for government stimulus, but we're in the times we're in, and the government's already saying, we know we have to support some sectors if this tariff war, this trade war carries on. So if we are sort of running out of steam there, where do we turn to? What's going on?
So, I mean, we're going to be more reliant on the private sector. Government, debt levels are at close to all-time highs. And so, we're going to see probably corporate tax cuts in the U.S. if that goes ahead. We're hearing from, whomever wins the election, we may get some corporate tax cuts in Canada, because there's basically a realization, no matter what your political stripe, that Canada needs to be competitive in this world. We're losing investment to the U.S. And just to give you an example, Marilla, a recent statistic I heard is that the U.S. invests roughly twice as much per worker than we do. And that's one of the main reasons our productivity is lagging so badly versus our major competitor and our major trading partner. And we need to fix that. Okay,
but that's going to get worse before it gets better.
It may.
Yeah. All right. We have Lorne Steinberg in-house, president of Lorne Steinberg Wealth Management, taking your questions today on global value stocks and fixed income as well. Here's how to reach us as we go to a break. We're back in a moment. Welcome back, and thanks for joining us here on Market Call. We're going straight to your questions. Andre has sent in a quick email question saying, your thoughts on tech, please. Again, this is from Andre. We will turn that over to Lorne.
Sure. So tech is the big metals producer, specifically copper and zinc being their 2 biggest metals. This is an incredibly cyclical business, Marilla, and I simply look at the fact that in 2011, the share price was higher than it is today, which simply tells you, has there been a lot of long-term value creation? There has not. You have to buy it when the price is down. It's easier to look for companies that are delivering consistent profit growth over time. So, we would take a pass on this type of business.
Okay, let's go back to our emails. Marcus has emailed us from Whistler, BC. When dealing with ETF based on U.S. market, does it make sense to own the unhedged version of an ETF when the Canadian dollar is strong versus the American, and switch to a hedged version of the same ETF when the Canadian dollar is as weak as it is right now? Canadian dollar slipping under the 70-cent mark, and we're not sure where it's going to go from here.
Sure. So I don't think it makes any sense to play the hedging game either way. The reason is, first of all, after 35 years in the investment business, I've never met anyone who correctly called the direction of the Canadian versus U.S. dollar with any length of time and success. Second of all, there's a misunderstanding by a lot of investors that just because something trades on the U.S. stock exchange, it's purely U.S. dollars. Companies like Microsoft and McDonald's have currencies, revenues from all over the world. And so if you simply try to hedge, you might be over-hedging the U.S. dollar exposure, and guessing doesn't make any sense. So to me, when you own equities, you accept the fact that you have currency diversification, and you're going to have some ups and downs due to currency moves.
Got it. All right, let's go to the phone lines. And we have Jim on the line who's calling us from Elliott Lake today. Hi, Jim.
Hi, good afternoon. Lorne, your thoughts on Novo Nordisk? I think it'd be kind of kind to say it's had a bumpy ride here as of late, even just 1 year out. Your thoughts on it? Could this be a good buying opportunity here?
Pharmaceutical company.
Sure. So Novo Nordisk, of course, is well known for its weight loss drug, and that's becoming a massive sector. The problem is there are so many companies now with competing products, and the FDA is looking at a whole bunch of drugs in that sector as well. Second of all, Novo Nordisk has been riding the hype on this one drug. And so, for us, there's too much weighing on this one drug. If someone else comes out with a drug that reduces, weight loss by an extra 10%, literally, that drug will move into the forefront. Better off to have a more diversified drug company based on more than one large product.
Got it. Okay, let's move back to the phones. And Mary's on the line from Burlington in Ontario. Hi, Mary. What is your question today?
Hi, Marilla. Hi, Lorne. Thanks so much for taking my call. Lorne, I'm trying to diversify a bit. I have a lot of Canadian holdings and a lot of American, but not too much anywhere else in the world. I'm wondering if you can recommend a stock that trades on a Canadian exchange, just to make my life easy, but that deals with another country, either by selling or whatever you choose, that's not Canada or the States. Thanks very much. I'll hang up and listen.
Yeah, looking overseas. Europe is a good market right now.
Sure. Now, Mary, you're looking for, first of all, thanks for calling. You're looking for a company that trades in Canada. A company like Saputo, as an example, of course, the big cheese company, cheese producer and dairy producer, has major operations in Europe. So that would be an example of a Canadian company that is a major global player in Europe that trades on a Canadian stock exchange. There are a whole other bunch of issues dealing with dairy and the commodities side of that business, as we know. But that is an example. Another example, might be, I would even say Magna, which is, of course, the car parts manufacturer, major operations over there as well, but of course, so much impacted by what happens on the U.S. trade side. So it's not so simple. And if you're looking for a company that is in Europe, I would suggest possibly looking at an ADR that trades in North America, at least, would be more exposed to Europe.
I'm just wondering about dairy, as you mentioned, the trade war, because, of course, it's going to be a target of Donald Trump at some point, right? We just don't know how much the trade deal is going to get opened up. Next year is when the actual deadline to reopen it is. Do you think the dairy sector is going to get a little bit gutted by any negotiation? So
we've already been through this once before. We've opened up Canada's dairy last time we went through trade talks. There's also a lot of pressure in Canada from Canadians. Why are we paying more for cheese and milk, et cetera, than they are in the States? So I think some of this pressure may actually come from Canadians, and I think it might be an easier place for our government to give in on something because of pressure from Canadians. And so it would not surprise me at all if our, dairy protection weakens or softens a little bit.
Got it. All right, we do have to take a quick break here on Market Call, but back with Lorne Steinberg, president of Lorne Steinberg Wealth Management, in a moment. Stay tuned. Welcome back to Market Call, and thanks again for joining us. We have Lorne Steinberg in-house to take your questions today. And this question next up comes from John, calling from London, Ontario. John, what's your question today? John, are you there? Okay, John, I'm going to give you one more try. Are you here? Okay, I'm going to ask a question for him. I think he wanted to know about how to benefit given the tariff situation. It's more of a general question, but it is one everyone's asking.
Sure. So when we look at what companies will do better in this environment if we get a tariff environment, we're already seeing the action over the last couple of days. So the consumer staple sector is outperforming companies like Kraft Heinz, Unilever, Nestle. It's not that they won't be affected by tariffs. Their costs would go up, but they're far less cyclical than a bunch of other businesses can view as well, which is the consumer products business that was spun off from Johnson & Johnson. Those are the stocks that are doing far better today, Marella, in this environment. And that just speaks to the advantage of having a balanced portfolio.
Okay, so if you're looking in that direction, you want something that is producing staples. And then would you still look at sort of a North American, if they have North American market, or would you look for less U.S. exposure?
So most of these companies like Unilever, which has, and Nestle, they're huge in North America, but they're huge globally as well. So they cover it all, but their earnings will be much more stable. So even if tariffs, do come back in again, even Kraft Heinz, which is more North American based, could their earnings fall 10% maybe, but they're not going to fall 50%. The dividends will be sustained. And those are the stocks, as I said, as we're seeing in the action the last few days, that will hold up better.
Got it. Let's go back to another question from email. Richard has written in, says, does Lorne see any appealing markets outside of North America? So Korea, for example, Brazil, Germany. Where are you looking outside of North America? Again, many people just want to stay away from the volatility as much as they can.
Sure, and of course, listen, whatever happens in the U.S. market just affects the rest of the world anyway.
True, yes.
We would not recommend emerging markets, and especially if we do get recessions, emerging markets tend to underperform. There's less, corporate governance there, et cetera. We do own stocks in Europe, and so as opposed to picking a market like Germany or something else, investors are far better served to, what are the best companies that I can buy in that market rather than just buying the German market. Germany's, the fourth largest economy in the world, but, they've got a whole bunch of issues with their own deficits and economic slowdown, that kind of thing. That being said, there are some outstanding European companies. I mentioned two of them, in fact, Unilever and Nestle, both European global businesses with great footprints.
Got it. All right, let's go back to the phone lines. We have Gordy on the line, calling today from Surrey, BC. Gordy, what's your question? Gordy, are you there? Seem to have a little bit of technical problems today, but I think Gordy was going to ask about Emera.
Sure. So Emera is a very stable business. And again, these are the kinds of companies that will hold up better. This is basically a Canadian utility type business. Steady dividend, slow but steady dividend growth. Is it a cheap valuation? No. But your dividends are going to be rock solid. It's better than average yield. Interest rates are low in Canada, so the dividend becomes even more attractive. These are the things that will hold up better in this kind of market.
Got it. Let's see if we can go back to the phone lines. We have a caller in Fredericton. I think it's Derek. Derek, are you on the line?
Yes.
What's your question today?
I was just wondering if Lorne still holds Viatris and if he still likes it.
Viatris.
Derek, thanks. So this is proof that not every stock that Lorne Steinberg buys goes up. Okay. We've held Viatris for several years. They recently came out with weak earnings, and the stock fell maybe 15%. It's got a 4% plus dividend yield. Is a drug company.
Okay.
Why do we still hold it? Because they're generating significant free cash flow. And Derek, let me say, they finally announced on this most recent conference call they're going to start using a bunch of their cash flow to buy back shares. The shares are incredibly cheap, and this should provide some underpinnings to grow this stock. And that's the best use of capital at this time. But the earnings were somewhat disappointing because they have an FDA investigation into one of their plants, and it's going to cost them maybe $300 to $400 million of EBITDA this year.
That being said, you're holding on to it.
Absolutely.
Got it. Okay. Let's go to Faisal, who is calling today from Toronto. Hi, Faisal.
Hi, guys. Good afternoon, Marella and Lorne. Lorne, good to see you on the show. Marella, you were doing a fantastic job on the show. And I must say that you're not some of the hosts pontificate needlessly. You're not. You push the calls through and you get to the point. That being said, Lorne, can I get your thoughts on Brookfield Corporation? It has sold off quite a bit over the last few weeks. I'll hang up and listen to your thoughts. Thank you.
Thank you.
Sure. Brookfield's one of our core holdings in our Canadian dividend strategy. It has been an incredibly well-run business. It's sold off a little bit, 10% or so, but if you look at the chart, it's just done extremely well. This is run by some really, really bright people. Some might call them evil geniuses, but what I will say is the CEO, Bruce Flatt, owns a significant chunk of stock. It's the bulk of his net worth. We like situations like that. And when you look at the business, it's basically an asset management business focused on things that are more illiquid, private equity, real estate, that kind of thing. Extremely well run for a long period of time. It is a quality operation.
Okay, so this is a longer term hold.
For sure.
All right. Viewer named Jake has written in. The email says, would now be a good time to open a position in BCE? And we've had a lot of questions about BCE. BCE, of course, Bell Media owns this channel as well as CTV news products across the country. So where do you stand? Because the stock has been going down and sort of hovering around, I think, $30.
Sure. So we recently added a little bit to our BCE position. So that's my answer, but I will caution investors, do not buy BCE for the current dividend yield, even though BCE said that they're going to keep the dividend as it is in 2025. We strongly believe the dividend will be cut in 2026, and we want the company to cut the dividend. BCE actually generates lots of free cash flow, Marella. The problem is they've been putting way too much of that free cash flow in dividend payments. We'd much rather see them take some of that free cash flow and pay down debt and invest in their businesses.
Okay, and there's been a lot of push for them to lower the dividend, so you likely think that'll come through next year.
We absolutely think it will. It should. There's pressure from investors who own the stock who want the dividend cut.
So that being said, do you think the stock will sink even lower next year? I'm just wondering for this caller, then should they buy in or should they wait another, 8 to 9 months?
So that's a great question. Early in my days, someone said, Lorne, I saw like a 10% dividend yield on stock. My colleague said, Lorne, the dividend is talking to you. If a dividend yield is 10%, the whole world knows it's going to be cut. No one expects it to stay at 10%. So if anything, we think the stock might go up a little bit because it will be a reflection that management is very focused on reinvigorating this business, paying down some debt, and putting together a better company. So we would expect the opposite to happen.
Yeah. Interpretation is always the interesting part of the conversation. Okay, we're going to take a quick break, but when we come back, we'll take a look at Lorne's past picks. What's coming up next? All right, time now for past picks. Lorne Steinberg is our guest in-house today, and we're going to share the picks for him for February 1st. This was 2024, so just over a year ago. The first one coming in at Compass Groups, PLC. At the time, it was 2143. These are in pounds. It is up significantly, 2606, so up 22%, Lorne, total return of 24%. What did they get right?
So Compass Group is an amazing company because they're in one of the most boring areas of all. They supply food courts, the largest supplier of food courts in North America and many other places. So food, napkins, all these different things. It's a very fragmented industry. So they've done a spectacular job at buying up smaller operations, integrating them, delivering double-digit earnings growth over a long period of time and for the foreseeable future. So their earnings look like a tech company's earnings. And they're the best in the business by far, and they just keep on growing. There's lots of runway, lots of room for this company to grow. So
it's a fragmented industry?
It's a very fragmented industry. There's lots of companies that supply food courts, hospitals, and other institutions, that kind of thing. And so lots of room for M&A and lots of room for this company to keep on growing. And they're the most efficient, so they'll buy these companies and then get them more efficient and then increase their earnings.
They're based in the UK or they're based?
They're based in the UK.
Got it. Okay. Let's move on to another pick from last year, which was Nike, which we don't get a lot of or we don't discuss a lot. Let's take a look at where Nike was at that point, 101.76. Recommended at, that was again February 2024. And now it's down at 77.81. 24% down return, 22% total return down. What happened with Nike, and would you consider holding on to it?
Sure. So we still hold Nike. We added to it recently at around this level. So Nike is the largest in the footwear and also the sportswear business. Under the previous CEO, they made some changes that were a disaster, trying to deliver products more online and less focused on their distribution network. New CEO, back to basics. They've run into competition from companies like On and the rest of it. Nonetheless, they are by far the largest in the world. They have huge free cash flow, minimal debt, incredibly well positioned, and at the current price, you have a chance to buy the world's best business in the sector. That's on sale.
What happened with the online push?
Well, the online push, consumers weren't ready for it. Consumers like to go to places like Foot Locker and elsewhere, try on shoes and that kind of thing, versus buy everything online. So Nike got ahead of itself just because they had some growth in that sector. It's part of the business, but it can't be the main part of the business.
Got it. Let's get to your last pick from last year, which was Starbucks, which is an interesting pick now, considering how much is changing there. 93.37 US recommended at now at 106.80, a return of 14% or total return of 18%. It's fluctuated. They've gone through a lot of change. They're trying to, I guess, now target more for their consumers hanging out in the environment and prioritizing that experience in-house as opposed to the mobile orders.
It's back to basics.
Yeah.
And just like Nike switched CEOs recently, and Starbucks switched CEOs in 2024, they hired the person who ran Chipotle's. It's amazing how quickly, in less than 6 months' time, the CEO is already putting a stamp on the business, reducing the number of beverages. 75% of Starbucks beverages are not even coffee. And so a lot of this stuff takes so much time to make, the iced
Frappuccino,
exactly.
The low-fat, the high-fat, something. Yeah.
Exactly. So they're improving the machinery. They're getting more people who are walking out of the store who are ready to place orders. This is all changing, and it's changing very quickly. Starbucks is moving back. They're going to grow this year and should be back to double-digit growth next year. We think we're in the early stages of a turnaround. It is an incredible franchise. Also, a lot of people put money on their Starbucks app. And Starbucks is sitting with maybe $3 billion of cash on their Starbucks app. So like a bank, they're making money, making interest off the float, like a bank or insurance company would. It's an incredible operation. They ran into some tough times. They have the right person, I think, running this company again.
So I just want to ask you, because they're trying to focus more on creating that, coffee house atmosphere again and have people hang out and drink their coffee in-house, is that, do you think, the way to go? Is that a positive way for them to go?
So I actually don't believe that's their complete focus, because mobile order remains an incredibly profitable part of Starbucks. You bypass the cashier, et cetera. It's more the welcoming, that consumers will feel welcome to hang out at their stores, but also getting the orders through much faster is a huge issue, and creating a better feel. And so much about retail experience today is about the vibe. How do you feel when you walk into the place? Getting back to writing people's names on cups, or "Have a good day, Lorne," or that kind of thing. I bought my espresso there this morning, and so a lot of it is just getting back to that culture again and making sure the people who work in the stores are happy. And because if you're happy when you work there, you're going to treat the customers better and that kind of thing.
More personal touch.
Totally.
Got it. All right. We're going to take a quick break. Back with Lorne Steinberg in a moment with your questions. So give us a call or send us an email. We're back in a moment. Welcome back to Market Call. We want to go right to your phone calls. Mike has been holding on the line. He's calling from Toronto. Hi, Mike.
Hi, Denise. Question here is on TransAlta Corporation. Is this a buy here? And I'd like to get your opinions on TransAlta. Bye now.
Thanks, Mike.
Thank you very much for calling, Mike. So we're actually looking at TransAlta. We do not own the stock. It is softened up considerably as of late. It has always been known for being a decent dividend payer. They cut their dividend a number of years ago, but they've gotten back on track. And this is the kind of thing we like to look at, a high-quality company whose share price has sold off somewhat and maybe an opportunity, but we haven't pulled the trigger yet.
What's the spike that we're looking at here for this year or end of last year?
The spike was due in part to strong earnings and a bunch of analyst buy recommendations, and kind of got ahead of itself for sure. Bit of disappointment recently, which, things have fallen back to earth as often happens. This is what we look for. We don't like to buy things when the stock is at necessarily that all-time high, and often tends to be more downside than upside.
But you definitely consider digging in now.
We're taking a look at it right now, actually.
Got it. All right, let's go back to the phone line. Steve is on the line. He's calling today from Vancouver. Hi, Steve.
Good morning. Thank you for taking my call. I'm particularly interested in ConocoPhillips. It's in my portfolio. I think a long time ago, Lorne had suggested it as a company, and it's had certainly a rough ride. And I wanted to know what he thought for the long term, whether I should hang on to it or let it go.
Okay, so Conoco crude oil?
Sure. So we've never actually owned or recommended ConocoPhillips. Just to let you know, we never held it. I'll tell you, the only oil stock that we have right now is CNQ, Canadian Natural Resources. Okay. Just came out with their earnings this morning. Actually, were pretty good. Our view is CNQ would be a much better company to buy. You're also getting a 5% plus dividend yield, and CNQ, even though they're in a cyclical business, has never cut their dividend, which is pretty amazing. So we think there's better upside, better downside protection. We think it's a better run business. CNQ is, one of the great energy companies in North America, actually, and with a great runway, and also one of the lowest cost producers. So CNQ, their break even is around $40 per West Texas barrel of oil. So, they're going to be in decent shape, even if prices were to soften up significantly. That would be our pick in the sector.
I just want to ask you as well, prices going the way they have been lately, sort of 69, 65 down to there. Are we going to see a slowdown overall industry-wide?
Well, certainly energy companies, when they're making more money, they invest more money. So when they're making less money, the capital expenditures tend to go down. Capital expenditures tend to go down, then there's more opportunity. People use more oil, inventories decline, and they have to invest more money. So this is, kind of the cycle. And certainly, if the economy slows down, everybody uses less oil, and that's what would bring oil prices down somewhat. But CNQ has been incredibly disciplined. They've ridden through these cycles without ever having to cut their dividend. And they've also got very long life reserves. So there's a lot of reasons, if you like the sector, to own a company like CNQ.
Got it. Let's go back to the phone lines. Jack is on the line. He's calling from Surrey, BC. Hi, Jack.
Yes, thanks for taking my call. Do you like the Canadian pipelines at this price? And if so, if you're going to buy one, which one would you buy? Thank you.
So pipelines also very interesting because there has been now discussion in Canada about expansion. Exactly.
And for a number of reasons. But of course, recently due to our reliance on selling our energy to the U.S. So we like TransCanada, which is TC Energy now, actually. Again, one of the things about these companies is TC Energy is part of it. Business is very utility-like, steady dividend, interest rates, possibly dropping a little bit more if the economy slows down. Their dividend will rise over time. So, I mean, this is a steady Eddie, hold it for the long haul. You'll get some growth. If we do get the opportunity for more pipeline building, that will be an opportunity certainly for growth for TC Energy. But we're not owning it because of that.
Okay, so you're owning it for what it is now. If there's growth, that's just a bonus for you.
Exactly.
Got it. All right, let's go back to the phone lines. Actually, not the phone lines. This is an email from Rick. And Rick says, do you like Paychex? Tell me about Paychex.
Sure. So Paychex is a payroll provider, HR services provider. It's done perfectly well over time, but we're far like more ADP, automatic data processing, by far the largest payroll provider in North America. ADP has outperformed Paychex over the last 1, 5, and 10-year period. They have extremely good growth. They're incredibly efficient. They are the monster in the room, basically. Companies as small as a company like ours or as large as huge businesses rely on ADP. They've got such a huge market share. They're expanding their offerings that we prefer that company.
Room to grow for them?
There's still room to grow, and because their services are expanding as well into related areas, and this is all automated. And so there's a lot of operating leverage there. It's not as if they have to hire a bunch more bodies to do all of this work. So there are a lot of operating leverage opportunities for ADP, and huge free cash flow generation. They're buying back shares, raising their dividend, all of which are accreting value to shareholders.
Got it. We're going to take a break, but Lorne Steinberg sticking around to take your questions. We're back in a moment. Thanks for joining us today on Market Call. We're going right to your phone calls. Frank is on the line today from Arnprior, Ontario. Frank, do you have a question for Lorne?
Yes, I do. Hi, Mr. Steinberg. I purchased Sun Life Financial a few years back on your recommendation, and I'm glad I own it. I just want your opinion on the stock now.
Thanks, Frank.
Thank you very much, Frank. So first of all, Frank, we still own Sun Life. Sun Life has done a wonderful job. They were also the best performing insurer in Canada through the financial crisis, just as a note there. Sun Life is more than just a Canadian insurer. They're also the largest foreign insurer in India, of all things, with a joint venture with the Birla family there. They've done an excellent job on both the life insurance side. They've got a great franchise in Canada, of course, but also in other areas as well, like asset management. Conservatively run, steady dividend grower, but we're also seeing, looking for 7 to 10% earnings growth over time. So we think Sun Life it's a core holding for us in our Canadian portfolio.
Almost 80% up over a 5-year period, so pretty much since the pandemic.
Correct.
Yeah. Okay, good to know. All right, let's go back to a question from Rocky. This is an email question. Can Lorne comment on Taiwan Semiconductor? Would you recommend buying at the price it is now? Let's take a look at where it is. Huge, booming company there and expanding more so into the U.S.
Sure. In Taiwan Semiconductor, what they do is they make chips for other people. So they make the chips for NVIDIA, Broadcom, and a whole bunch of other companies benefiting from AI. They don't develop all the stuff. They don't compete with those companies. They've eaten Intel's lunch. And if you look at the performance of those two companies, listen, it's a core holding for us in our global portfolio.
But when would you have bought in? Because right now it's at 177.
So that's a great question for any investor. If we own something, that is because we could sell it today if we didn't think it offered upside. So by owning the stock, we think the stock and buying it for new clients, we think this company offers at least double-digit 10% annualized upside over the next 5 years. Their earnings are going to jump significantly this year because the plant in Arizona is coming on stream. They've got much more investment to come. They've been very disciplined, but the growth for this company over the next 2 or 3 years will be in the 15 to 20% annualized range. So there is lots of upside here. And companies like NVIDIA have no choice. They must use Taiwan Semi to do their manufacturing. They're not going to get into the manufacturing business. Look at the cost of these plants. You can spend $50 billion. I mean, these are huge investments.
So even at this price, you would dip in?
Absolutely.
Got it. All right, let's go back to the phone lines. Email from Chris. He says, may I have your guest long-term view on Uber? Uber is in a lot of countries, but still expanding.
Sure. Listen, we don't own Uber, and the reason is simply valuation. I myself am amazed at how well this company has navigated against competition, and the whole Uber Eats is phenomenon now. It's like every restaurant my office, orders from all seems to be on Uber Eats. They've done a spectacular job. There's huge leverage there. These are, of course, very, very bright people. It's just the valuation for us is too expensive. One could say it's one of those stocks we missed 5 years ago, which happens all the time. We can't step into it today, despite the fact that management has clearly done an outstanding job.
I thought Uber Eats itself would take a hit post-pandemic. People are out more, picking things up on their own more, or walking out for lunch from the office as opposed to ordering in. But you're saying that's still trending quite well.
There are an amazing number of people who, regularly order lunch and their dinner from Uber Eats. It remains an expanding business. And all these other competing services, Uber Eats has taken market share there and seems to continue to do so. And, every restaurant you look at, from a, pizza place to anything else, they all offer it now on Uber Eats. And it's become the default for a lot of people just to use the Uber Eats app because they get, credit for if you order a number of times, their loyalty points, which just keeps on driving traffic.
It's all about the loyalty programs these days. Okay, let's take another email. This one is from Jean saying, on the railways, CNR, CPKC, both stocks seem to be holding well given the current context. I would have thought that reduced cargo due to a slowdown would impact the stocks. Your opinion? Good point. We're at the start of a trade war, so maybe not heavily affected cross-border commute. But what's your take on investing in the rails at this point?
So first of all, we own both CN and CP. They are core holdings for us. The reality is two things. One, Morella, because of environmental reasons, no one's building any more rails. So these companies have like a duopoly here. Second of all, it is cheaper to ship a lot of goods and a lot of commodities by rail than any other way. So, if you're a producer, you might be subject to tariffs, but you have no choice. You have to use CN and CP for various different products. And, if there's an economic slowdown, traffic will slow down. Volumes will slow down for sure. These companies are not immune to that. That being said, they've got phenomenal franchises. And if you're a shipper, you don't have any choice. You've got to use them. And so even if prices go up, if demand remains the same, they're going to still charge their, X dollars per ton or whatever it is per truckload for truck railway load. And it's a pretty steady business.
That being said, as you said, there could be a slowdown, but the longer a trade war goes on, the harder they're likely to get hit.
Oh, there's no question, because if a trade war goes on, everything's more expensive. People have less money to spend. We possibly move into recessionary territory. That negatively impacts these two companies. They have some room to reduce costs should that happen, but not enough to offset the eventual profit decline. But those things are always temporary. And, when we talk about even these trade wars, Morella, I have to say that trade wars, they're inflationary and recessionary. Politicians don't win during inflationary and weak economic times. And so the U.S. has, midterm elections in just 2 years' time. And if you're running in a place that is competitive, you better have a strong economy and not a lot of inflation, or history has taught you're probably going to lose. So we think rational minds will prevail.
I was going to say, Lorne, Donald Trump wins every time. No matter what happens, he wins every time. Rational mind will prevail. We'll stick with that as we go to a break. That's all the time we have for phone calls, but we have top picks for Lorne coming up. Stay tuned. And join us tomorrow for Market Call. Mike Vinokur will be on the show, portfolio manager at MV Wealth Partners with IA Private. He'll be taking your questions on North American large caps. That's coming up tomorrow. And if you missed an episode of Market Call, you can find your daily podcast. It's available on iHeartRadio, also available on Spotify and other podcast platforms. Back in a moment. Welcome back to Market Call. It is time now to take a look at top picks from Lorne Steinberg. His first pick is American Express, AXP, on the New York Stock Exchange. Why do you like American Express? Are we racking up a lot of credit here?
We love American Express. Good line, Morella. American Express, people think of it as a charge card, but it's also very much a credit card. People, look at American Express, and it's true as being positioned higher on the socioeconomic side than things like Visa and MasterCard. American Express has had an absolutely spectacular track record. A lot of these companies suffer, during financial downturns, but American Express was extremely profitable right through the entire financial crisis. They're delivering earnings growth in the 15% annualized level still, and use so much free cash flow, excess cash generation, that they've bought back about 40% of the stock over the last 20 years. They keep on jacking up their dividend at 18 times earnings for 15% annualized dividend growth. This company is extremely cheap. It's also a core holding for my good friend Warren Buffett. So it's.
Why do you think they've done so well in these more difficult times like the financial crisis?
So first of all, they don't have a lot of credit problems. They tend to focus on consumers that will have an easier time paying off their cards. So you might get, some people might get turned down for American Express card, whereas a lot of the other cards are throwing cards out, left, right, and center at airports, et cetera. And so that is certainly one of the reasons. Two, consumers, some higher level consumers tend to be much more steady, less impacted by a recession. The CEO of a large company, recession or not, is still going to do their travel and other things like that. So it tends to be a steadier type of business. But they've also continually gained market share, continually expanded their core offerings, but it's very much sticking to the knitting. So they're not getting involved in a whole bunch of other areas. And they take their excess cash and they allocate it so well. And if they don't find things to do, they just buy back more stock. And it's been a spectacular performer over such a long period of time. It truly is a Warren Buffett. It is a spectacular company at a very reasonable price.
Got it. Okay, let's move to your next top pick, which is Bank of Nova Scotia. We know they had earnings out recently, and there is some room to grow. A lot of them are putting aside a lot more money for creditor protection, that kind of thing. Why do you like Bank of Nova Scotia over the others?
So first of all, we own 5 banks in our Canadian portfolio. But I have to say Bank of Nova Scotia has been absolutely by far the worst performing Canadian bank over the last decade. That's one of the reasons we like it. So the stock has underperformed. The dividend yield is 6%. 2 years ago, they finally changed CEOs. And this CEO has the freedom to really exit a bunch of underperforming businesses, for example, especially in Latin America. They announced in January they're exiting Colombia, Costa Rica, and Panama, selling it to a company of which they'll own 20% of, but taking the capital, allocating it back into North America, into their core businesses. They made, an investment in the U.S. We'll see how that does. But their earnings are poised to rise significantly next year. They will improve this year, but in 2026, we're looking for a sharp increase in earnings as this capital gets properly allocated. With a 6% dividend yield, you really don't need very much to go right for your stock to do well. It's not that we expect Bank of Nova Scotia to outperform in terms of, earnings growth and other metrics. We just expect the gap to narrow over the next few years. That alone should deliver at least a 10% annualized return to investors for the next 5 years.
Got it. Okay, let's get to your last pick for today, which is Diageo, which is a spirits producer.
So Diageo is the largest spirits producer in the world. They bought the Seagram's brands many years ago, and they're focused on the premium brands like Johnnie Walker and a bunch of other things, also Guinness. And their focus has been to to buy great brands and then come out with even higher priced brands. So there used to be Johnnie Walker Red and Black. Now there's Johnnie Walker
Every
Green,
color
Blue,
of the rainbow,
Gold,
yes.
And the prices go up to several $100s a bottle, and there remains a market for all of that stuff. Okay. The stock is selling at a 10-year low. Post-COVID, revenues have flattened out. Wall Street's not enamored with the management team. And for us, just like when Starbucks, Wall Street wasn't enamored with that management team, bunch of issues. They just got rid of the management and they hired, the best in the business. When you're Diageo, you can hire the best CEO in the business because you can afford to. And
is there indication they're going to do that?
There's rumblings, I will say. We're not there yet. But you get a chance to buy the best in the business at 16 times earnings. So a cheap valuation based on trough earnings, a 3.3% dividend, earnings poised to rise. We're looking today for Diageo to return to, that 7 to 10% earnings growth. And this stock should be a double for us over the next 5 years.
Okay. Just wondering why you said post-pandemic. I think most of us understand why the stock would take a hit. Anybody in the capacity likely did, because people were at home and they were probably drinking a little bit more than they normally do. What else has hit it? Is it just that, as you say, the management team isn't really working that well?
So I don't want to make that comment because I haven't,
Sure.
Can't evaluate the management team perfectly well, but just a track record. Things have slowed down in Latin America. That's been an issue. Some of their brands have been underperforming. We're reading articles, of course, all over the place that alcohol might not be great for you. Okay, so these things tend to have an impact in the short term. I well remember the cover of Time magazine when there was a Time magazine, 25 years ago about trans fats. Will people still eat French fries, 10 years from now? Guess what? People still go to McDonald's. Nothing there is probably great for you, but McDonald's is soaring, and consumers tend to return to their behaviors over time.
Okay, so people will pick up again. It's just a matter of time.
And also, though, the premium side of the business, the really the higher quality stuff, that is where the growth is. People are drinking less but drinking better. That trend is continuing, and we expect it to continue.
Lorne, thanks for coming in. Really appreciate seeing you. Good to see you. Thanks for that. And we are going to leave it there on Market Call. Thanks again for joining us. We'll see you again tomorrow.